Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. First, I apologize. Some of my recent videos, the audio has been extra low. I messed with some settings. I believe I've fixed it. Somehow my computer decided to just drop it to 50% for some reason. But anyway, it should be working much better now. Today is Thursday, June 13th, 2024. In today's episode, we'll start with PPI. The PPI, down here I have it, month over month. The actual was actually negative, so we had deflation in PPI, month over month. Now you gotta consider seasonality into this. The last reading of this was 0.5%, expected was 0.1, and instead it was 3 points lower at negative 0.2. So year over year, the last year to year reading of this was 2.3%, and then this one was 2.2%, which is a pretty friendly number, pretty close to that 2% target that Powell's always talking about. And then the core PPI month over month, last was 0.4%, expected 0.2%, and the actual 0, so it was flat month to month. And year over year went from 3.2 staying flat at 3.2. Overall, there are some cracks in the stickiness of inflation, is kind of what I'm seeing here. Adding to that, we're going to go over the initial jobless claims. This is a weekly reading. The last weekly reading of this was 229,000. The expected was to be lower at 225,000, but instead it grew to 242,000. This is particularly notable. When looking at the Fred website, we can see the chart of initial jobless claims. We're still not up to the height of June of 2023 at 261,000 for one of the weeks. And since then, we've been actually going down, but then since about January 2024, this has been ticking back up higher and higher, and all of a sudden we have what looks like a breakout. And so it'll be interesting to see if this is it, and this really explodes higher from here or not. From a personal standpoint, I think it might. I think it will. I live in Fort Lauderdale. I can't tell you how many restaurant closures that I'm seeing. Places that I've been wanting to go for a long time are gone. Like, rows of them are gone. Businesses are closing right now. I mean, this is just personal, like, what I see out there. But, adding to the unemployment, adding again to the fact the Fed is strangling the economy, we're due for a major slowdown, and I believe a major correction in stocks. The markets don't seem to see this yet, but I am gaining confidence in that viewpoint, and I'm going to share a few things that may support that. Just want to go over this next point that I'm writing here. Stock valuations are out of control. The music is still playing, mostly because of Magnificent Seven. I'll note that, I noticed looking through my charts today that in cannabis, Bitcoin, silver, and in small caps, things are looking a little bit weak, all while S&P 500 and the triple Qs and semiconductors, SMH, are finding new highs. Notably, something I noticed Gareth Soloway mentioned on his show today as well, the Russell 2000, the 2021 high was never taken out. We are not at all-time highs in the Russell 2000, and a lot of people do use that as another leading indicator. Back to why I believe the S&P 500 stock valuations are out of control. We are currently at an S&P 500 PE ratio as of today, actually at 28. Now, looking back, there's been times where we've been higher than this, but sometimes that's because earnings are contracting. And then if the price even stays the same, this PE ratio goes higher. And we haven't even seen a contraction exactly in earnings. Although, like you saw in the last show, we're not to new highs in earnings, and I find that notable as well. I want to mention something else. I'm currently reading through and doing a series on The Intelligent Investor by Benjamin Graham. And, one thing that is just very important to realize and remember is that the yields on bonds right now are like on treasury bonds even, they're over 4%. And, if treasury bond yields were at 1%, at half of a percent, maybe this kind of PE ratio would make sense. With these yields being so high, it makes even less sense. It would make a lot of sense for stocks to lose a lot of value right now, in my opinion. But hey, who cares about my opinion? After all, stocks are, like Benjamin Graham said a long time ago, the valuation of stocks, the stock quotations, are a voting machine, not a weighing machine. And for now, people are voting higher. People are actually buying stocks here and sending the value higher. This is the S&P 500 closing all-time high once again today, Thursday, June 13th, 2024. Similarly in the triple Qs and the NASDAQ, all-time high. We blew right past, by the way, my target of 470 from this previous reverse head and shoulders here. SMH as well. Semiconductors, all-time high. Benjamin Graham talks about when valuations like this get this high, it's not just like, okay, well, they go up and they go down. No, this is extremely dangerous, is the way that I would refer to it. Again, this is not a channel of investment advice, entertainment value only, but it is my strong opinion that stock valuations are extremely dangerous right now. High yield corporate doesn't seem to mind right now. They don't think that there's going to be there's that much risk of bankruptcy. So, again, this fund HYT, it sort of represents like the craziest of the smart money. Smartest being maybe what's going on in the treasury market, and then regular corporate bonds, and then third, HYT. Maybe if we're going to continue this, okay, then S&P 500, then the NASDAQ, and then the Russell 2000, and then maybe ARK funds, and then maybe Bitcoin being the least smart money, I guess I would call it. But the music's still playing, the VIX is just going down here. On a closing basis, it's pretty darn close to, lows that have not been repeated very often for a long time. Notably, though, finally something agreeing with me what's going on here. Fear and Greed Index on CNN, we flipped to fear today, all while we have new highs in the S&P 500. How crazy is that? I also wanted to bring up Fed funds futures. Just on the September meeting, we have, off of the PPI data coming in cooler than expected, we have a actually stronger chance now of one cut in September than we did yesterday. Yesterday, we still had a higher probability of a cut than not a cut, but now, there being no cut has been reduced to 30.5%, and a cut had a probability of 63%. Along with all of this, TNX, this is the 10-year Treasury yield. It's breaking down. This is very favorable to my positioning in Treasuries. It's more related probably to TLT. We're breaking out here, and this is starting to become obvious, a more obvious pattern of higher high, higher low, higher high, higher low, higher high. And so it is, chart pattern wise, we can expect this pattern to continue. If stocks collapse from here, as I think they should, money should be rushing into treasury bonds, and this should be a really great place to be, in my strong opinion, over the foreseeable future. I'm thinking 3 to 6 month time period at this point. And that's all for today's show. Hope you enjoyed. Thank you for watching. Robschild.